Welcome to part 2 of Stock Investing for Beginners. Now that you learned some basic financial principles in part 1 of this series, let's start investing in stocks. There are several ways you can invest in stocks. You can invest through 401k plans or IRAs, individual retirement accounts. These are tax-deferred long-term investment vehicles. You can invest in equity mutual funds, ETFs, or individual stocks. And the first place we're going to look to invest our money is in tax-deferred retirement accounts like 401ks and IRAs. Now you've decided you've got some money and you want to go into the stock market. Are you able to participate in a 401k at work? This is the first place you should look because stocks really should be looked at as a long-term investment. That's going to give you your best return, okay? And you want to make sure that you've exhausted that first because very often your company will match what you contribute to your 401k plan, and that money that you put in is before tax dollars. So it's a very lucrative thing for you to do. If you have a 401k plan at work, you have access to it, please take advantage of it if you can afford to. If you need the money to live and pay bills, then of course I understand, and you don't want to do it then because you need those dollars to live. But if you can afford anything, you can put up to $18,000 into a 401k plan. Now, I always suggest you put in the maximum amount that the company will match. If your company will match 3%, that means if you put in 3% of your salary for the year, they will match your 3% and put that into your 401k plan. The only thing is with 401ks is you cannot access them until you're 59 and a half. They are a long-term savings vehicle, but they grow tax-free. And that's a wonderful thing to have. And then you have your little nest egg growing for when your retirement years or your later years come. Don't have to worry about that. And it's going to be growing and compounding tax-free. And then you can take that money, that 401k money, and you can put that money into something. You get to invest it. You can invest it in stocks and bonds or whatever they offer. More than likely, your best choice is to put it into some type of that tracks the S&P 500 index. Okay, that's what I did. I put it in a mutual fund that will track the S&P 500. So as the S&P 500 would go up, so would my 401k plan, my portfolio for my 401k. And the S&P 500 is the 500 best stocks that trade on the stock exchange here in the United States. Okay, they're great, great stocks. And they pay dividends. So you get a dividend too. You get dividends from those stocks. And dividends, be surprised how they build up over time. Dividends are sums of money that a company pays out quarterly to its shareholders from the profits of the company. And the average annualized total return for the past 100 years for the S&P 500 index, which includes dividend reinvestment, is 10.41% on your money. More than a quarter of all those years saw better than a 20% gain. So it is something you want to participate in. It is something you want to take advantage of whenever someone is giving you free money like that. If your company is giving you free money, they're going to match you 2 or 3% or whatever it is. Take it. It builds up over time. And don't worry if you leave that company because you can roll that 401k plan into some other 401k plan at your new company, or you can just simply roll it into an IRA at a Vanguard or any mutual fund company. Okay, that's the first thing. Now the second thing is you can open up your own IRA, and every year you can contribute up to $5,500 tax-free. You even get a tax deduction for it, and you can invest that money into stocks. Again, stocks are also called equities, so an equity fund, and you can grow that money tax-free, and it'll accumulate dividends and reinvest the proceeds, and over time that will build up. So if you don't have access to a 401k, then you can do an IRA. Okay, but this should not be money that you need to live. Okay, this is not your first dollar of income. This is your last dollar of income. Now, let's just say you've got all those things in place. You've got your 401k or your IRA, so you've got your little retirement fund set aside, or maybe you want to create your own little retirement fund. You can do this by investing in equity mutual funds, ETFs, or individual stocks. Now, unlike the 401ks and IRAs that we just covered, these investments are not tax deferred. You will have to pay taxes on any realized capital gains each year. First, I'll cover equity or stock mutual funds. A mutual fund is a professionally managed investment fund that pools money from many investors to purchase stocks. The value of the mutual fund depends on the performance of the stocks it buys. So, when you buy a share of a mutual fund, you are actually buying the performance of its entire portfolio. The average mutual fund holds hundreds of different stocks, which means mutual fund shareholders are very diversified. And there are so many of them. There are ones that are growth-oriented, there are dividend-oriented, there are ones that are in mutual funds for the tech sector, and you just simply take your money, you write a check to one of them, they put in the mutual fund, and it's very diversified. You are very diversified, which is really good because you don't get exposed to the ups and downs of any one particular stock. And that's how you hedge against the volatility that is inherent in the stock market. You try to spread your investments over many different companies, and then you are more resilient to the ups and downs of the market, okay? And then you don't have to watch it so much either. So you can be involved in building equity and taking advantage of growing dividends and growing wealth, but you don't have to watch it. You can send it to a mutual fund company, either with the ACH transfer that I just told you about, or writing them a check and depositing it there and just, letting it grow. And it will, and you'll get dividends, and it'll increase in value, and it'll do well, and you can put your money in that too. But let's just say you want to be more actively involved, okay? You want to be in the stock market like me, and you want to be more an actively involved person, and you want to trade, and you want to make buys and sells and make money and see how well you can do. In my experience, the best equity investing and trading vehicles for beginners who want to actively manage their own investments are to trade in ETFs or individual stocks. So what's an ETF? I'll explain. ETF stands for Exchange Traded Funds. Exchange Traded Funds are investment funds that trade like stocks. It's like a mutual fund that trades like a stock, and the costs are lower for the investor than a mutual fund. An ETF holds a basket of stocks, so it's very diversified. Exchange Traded Funds are very popular now. They will enable you to diversify your money across different stocks. ETFs will invest in a bunch of stocks. So when you buy a share of an ETF, you are in essence buying a share of a bunch of companies. For example, if you buy shares of the PowerShares QQQ, you will be buying an ETF that tracks the NASDAQ 100. The NASDAQ 100 is an index that is comprised of 100 of the largest companies traded on the NASDAQ stock exchange. The QQQ is heavily weighted towards the technology stocks. When you buy the QQQ, you are actually buying some shares of Apple, Microsoft, Amazon, Facebook, Alphabet, which is Google, Intel, Cisco, Comcast, and NVIDIA. There are more, but those are the top 10 holdings of the QQQ. So when you buy a share of the QQQ, you are getting a piece of all of these stocks and more. See, now that's very diversified. That's why exchange traded funds, ETFs, are diversified. Just buying a share is already diversifying your portfolio. So now you want to take some more money and invest. Well, don't buy stocks in the tech sector. Maybe go buy an ETF or an index fund in the banking sector. You buy the XLF, and that will invest in banks. So now your money isn't just in one bank, it's in, 20. Your money isn't in just one technology company, it's in, a bunch of them, 20 or more, depending. That is one of the best ways to diversify if you're going to be trading stocks, is using ETFs. So you can have a portfolio of ETFs. I did that for my daughter. I diversified her into the S&P 500, the Dow Jones Industrial Average, the QQQ, and among those she's diversified across many stocks, and this is kind of her way of saving for her future. This is a long-term account. I don't actively trade it. I try to buy when the stock market is down. I have certain principles which I will share with you in other videos on how I've managed to buy well. It's like anything else. I want to buy when things are on sale. I don't want to pay top dollar for something. I'm going to teach you how to do that, and it's a really helpful way to make the initial purchase. And you will have to have a brokerage account. And there are so many online brokers out there, but you want to pick one with low transaction fees. I use TD Ameritrade. I like it. It's a good platform. I used to be with Scottrade, and they were bought out by TD Ameritrade. So that's how I ended up at TD Ameritrade. They have $6.95 trades. So when you buy a stock, you pay $6.95, and when you sell a stock, you pay $6.95. And it doesn't matter how many shares. Whatever the amount of shares, whether you sell one share or you sell 500 shares, it's still $6.95. And there are others. Some are cheaper. Some are more expensive. There's Schwab and E-Trade and Fidelity. Those are all really good platforms where you would open up an account. You just go on their website, you fill out the information, and then you have to fund it. Basically, you have to put some money into your brokerage account. And you can either send them a check through the mail, or you can, like I told you before, use ACH transfer and send the money by wire transfer into your account from your checking account. And that's how you fund it. And most of those brokerage accounts have no minimum requirements. You can put as much or as little as you want. Some offer free trades. You can shop around. It's up to you. Now, I recommend if you're going to open up a brokerage account that you probably not open it up for less than $500. I think you need to start with at least $500. I think anything less than that is too small. You really can't buy much. And the last area I'm going to discuss is what you need to know about investing in individual stocks. Okay, so let's just say you want to day trade now. You want to buy Nike, you want to buy Apple, you want to buy Facebook. You like these stocks. That's what I do now. Now we're getting down to buying single stocks. And that takes some homework, and it takes following them and knowing what's going on with the company, paying attention to when they release earnings, listening to conference calls that go on. You have access to all of this online. It's easy to get access to this. Years ago, you had to have a broker that you called, and he did all that work for you. But now, if you're interested in this and you want to make this a hobby or a career for you, you can do this yourself. But you have to take it slow and build knowledge, because when you first start, there are so many companies and you just don't even know where to begin. So go to the cream of the crop. Go to the companies that are doing well, that are flush with cash, the Apples of the world, the Googles of the world, or Alphabet, which is the parent of YouTube. Wonderful company. These are great companies. These are Fortune 500, because these are top companies in the world. And they do very well. And they have cash on hand, and they have very little debt, and they operate, and you can see their products, and you know what they're doing. And it's easier for you than something obscure that's in another country, or perhaps you can't see it, and you really can't get a feel for whether or not it's going to be successful. Stick with what you know. Okay, Peter Lynch always said that. Stick with what you know. Warren Buffett. These are like some of the icons out there. If you get a hold of any of their books and you want some good reading, I've read all their books. They're great books. They will teach you discipline. If you are going to be in the stock market, it's really a practice of discipline. You've got to be able to stomach the down days, and you have to tame your euphoria on those up days, and you just can't overreact. You've really got to train yourself, and you've got to say, look, I want to be in this for the long haul, and I don't want to lose money. So I want to do this right. I want to learn what I can. I want to use all the avenues that are available to me. and I want to go from there. Now that you know the process, this is kind of a beginning introduction for you, where you can assess your own financial health and you can decide, am I really at a point in life where I want to go into the equity markets? Because can I afford the volatility? If I need that money next week and the stock market's down and my $500 is now $200, how do I feel about that? Because you have to have a time horizon with the stock market. You have to be able to endure those ups and downs, and you'll be rewarded. You'll be rewarded for holding it over time. Do I believe in the whole buy and hold forever? Not really, because I think the landscape changes. Companies change. Things go, especially with the way technology goes, everything is always evolving. So I think you always have to pay attention to where your money is. I don't think you can plunk it somewhere and just forget about it. You want to stay abreast of what is going on to make sure you still like the companies that are in your portfolio. And if you don't, you can sell them. Okay? So, whatever money you think you want to put into the stock market, my advice is cut it in half and start with half of that in, because you're going to need that other half. And I'll explain to you in future videos why you would need that other half. But it's basically to help support the half that you put in, should you ever need to. Okay? There are common mistakes that a new investor can make, and here are some things that you want to avoid as a new investor. Speculating in penny stocks. Penny stocks are very risky. You can just avoid them. Stocks trading under $5. If a stock is trading under $5, that means the company has some kind of a problem. You can look at their stock chart. If it's gone straight down, you know that there's an issue at hand. Turnarounds are hard. You want to just avoid that. Putting too much money at risk in one stock and paying too much for a stock. You'll need to learn some basic valuation tools like PE ratio and PEG ratio, and that'll help you value a stock and let you know whether you're paying too much for a stock. And I can teach you about that in future videos. Now, the best thing I think you should invest in are dividend stocks, because when you buy a share, now Facebook, my example, does not pay a dividend. Companies that are focused on growth will generally not pay a dividend. However, Apple does. Apple is also focused on growth. It is a tech company. It is a name we all know. It is a fantastic company. It's a company I've personally made a lot of money trading and investing in, and it's a very safe company. Can it go up and down? Oh yeah. Does it go out of favor sometimes? It sure does. People are throwing darts at it all the time. It's very hard to decipher when you look at information online. Be careful with that. You have to do your own homework. Listen to the company itself. Listen to Tim Cook when he talks and tells you about what's going on. The analysts and people who are trading and making markets for a living, they tend to hype things up or they tend to shoot it down because they're trying to generate interest for not only themselves as an analyst, but also for the company and for traders, and they kind of make a market in it. They kind of try to make the stock go up and down. Be mindful of that. You've got to catch on to what's going on. This takes time. It takes time to get your feet wet. It's fun though. It's fun. It's educational. You will learn a lot. And one of the best ways to learn is to put your own money in, to put your own skin in the game, because when your money is in, you care. You care about it. You're not just going to turn your back on it. Now, we just recovered from a very big trauma in the stock market, which is the year I got in, believe it or not, 2008. We had a tremendous recession. The stock market went down, I think, like by half, and it just kept going down. And hedge funds went belly up. People lost a tremendous amount of money and wealth, and there are still people fearful of that happening again, and rightfully so. You need to be mindful of the downside risk. There is an opportunity cost of doing everything in life. You are always giving up something to get something, and it has to be worth it what you're getting. So be careful with your hard-earned money. I will try to help you in my videos. If you're interested, let me know. Then to guide you as best I can with what I've done and what's worked for me. But then go off on your own, do your own thing, watch other videos, look into it, watch programs on television. I think you need to start watching CNBC regularly, okay, and reading their website and following the market. Get familiar with what it does. And if you're interested in a stock, watch it for like a few weeks. Just watch what it does. Watch how it goes up and down. You know, most of these trading platforms have virtual trading where you can pretend to own something and you can buy it, then you can watch what it does. You can get to know who are the big players. You gotta know, you gotta like their management. You gotta like, you know, who's running the company. You get familiar with all of that in time. There's a lot of exciting, dynamic stuff that goes on. You'll learn so much, really. I inspired my son to get involved in the financial markets. I told you in that video that I did that he was always business-minded, entrepreneurial, that type of spirit, and he saw me get into it, and he got inspired. And he started doing it in school and getting involved in clubs that did it. And, you know, after a while, and he learned, I let him open up his own brokerage account. Like I told you, we had a business together, and he was making money. Now, I didn't take his only money, okay? We made sure we put some money aside for college and for savings and spending, and then we took a portion of the money and said, okay, let's learn. We'll start an account. And he made mistakes like anybody else would make, and he learned from them, and that's the key. So starting small. So, I mean, you can start if you're in your teens. This is a fantastic field of interest, a fantastic hobby. And, you know, the sky's the limit on the money that you can make and the knowledge that you can acquire. Okay, well, I hope you found this video helpful. I hope I've inspired you to invest in the stock market, in equities, and maybe even do some trading, stock trading like I do. If I've spurred an interest in you, then let me know. Let me know in the comments below if you have any questions that you need answered, because as you're learning things, you might come up with questions that you want answered or explained, and I'm happy to do that in the beginning of every video, answer some of the questions that everybody had, and then maybe get into the financial education part of it. Okay, I think that might be a good idea. So, you know, let me know. I'm going to work with you on this. And if you're new to my channel, please subscribe, because I have a lot more to come. Something of interest to everyone, including more stock videos. And please visit me at my blogspot where I do a lot of writing. And I'm also on Facebook and Twitter and Instagram, so we can stay connected there as well. Okay, well, thanks so much for viewing. Bye-bye now.